Welcome back to Trade with Conviction, where we cut through the noise, dodge the clickbait, and occasionally get our market calls right. So it's been a busy week again. Saudi allocations surprising the market, sanctions doing their usual dance, and refinery capacity suddenly the hottest topic in town. We're going to try and make sense of it all, or at least sound convincing while we do. So look, James is here to take us through what's driving those wild distillate spreads. Jorge's got the latest on gasoline and naphtha, and Phil's wrapping us up with a quick fire round on fuel oil and crude, including some truly heroic attempts to make refinery bottlenecks sound very exciting. So look, without ado, why don't we just get straight into it? Phil, I think it's over to you. Why don't you take us through the headlines for this week?
Rachel, going to rattle through these relatively quickly. I think there's not a massive amount in terms of new news, but there are some developments on those drivers that we've been talking about for weeks now. The only bit of kind of new news, I suppose, would be the Saudi term allocations that's worth talking about. They were surprisingly low to China in December, so it's not clear whether that's kind of lower buying overall. I know that there was some concerns about crude import quotas in China, so it might just be that. Could be them taking more than expected Russian. We know that they're taking a lot of ESPO, particularly at the moment. Overall, it looks like it's a boon to India, who are expected to take more term crude. And obviously at the moment, as I think June mentioned already last week, we're looking at 2026 term deals right now. OSPs are priced quite attractively for that. Broader market, if we take a bit of a step back and look at kind of sanctions impacts, they've reared their head again because the Gunvor deal to buy Lukoil assets has fallen through, it seems. So White House called some, I think it was Kremlin puppets or Russian puppets. So that obviously didn't go down well. And if we take a look at kind of the biggest impacts of that, we have force majeure on some elements of the Basra heavy fields. So, and in a bit closer to home for us, we have the Burgas refinery in Bulgaria, which looks as though it's going to be struggling to maintain operations at these rates. So there's some concerns in Bulgaria, at least, about gasoline inventories. So some tightness in Black Sea products markets there. Not being helped, of course, by the fact that the Ukrainians have not been stopping or turning down the attacks on Russian oil infrastructure. So almost every day you get a new piece of news about a refinery or a port that's being hit. So that is something which I think we need to bear in mind as we talk about distillates and light ends and crude markets through the rest of the podcast. And it brings us back to this, to the final bit that I wanted to talk about, which is refinery capacity. We've been talking about it for quite a while now, but I think this is the last couple of days, each of us has been getting a few requests from journalists to start talking about this thing. So it's getting a bit more widespread attention. It's very difficult to judge at the moment whether this is the fact that we've got lower Russian exports or fears of lower Russian exports, or whether it's just this structural missing capacity. Right. We will have capacity returning through this month. We are still in turnarounds in parts of the world. And so I think just before I do hand over to James, I'll throw in my favourite topic. Maybe Dangote is going to surprise the market by not going into turnaround potentially in December. There was a caveat that was it was optional based on market conditions. So maybe Dangote doesn't go into turnaround in December, and that can be our little bearish catalyst for the clean product cracks to fall. I don't know, just throwing that out there.
Yeah, fair enough. I can't believe Dangote got mentioned so early on in the podcast. Usually we kind of try and thread this through somewhere else.
If I'm on the week, then there we are.
Yeah, thanks for the upgrade to that one. So, okay, one to watch then in that case. Thank you so much. That was short, sharp, and to the point. In that case, why don't we just move straight into the products then? Because you did a really nice segue there into James. So look, James, it's been very volatile and seemingly headline driven in the global middle distillates since you were last on the podcast about 2 weeks ago. So why don't you give us a roundup, particularly from a pricing perspective?
Yeah, well, it feels like we've been saying the same thing when I've been on the podcast the last few times, that we made a bullish call and it's kind of come off correctly, but there's geopolitical reasons that have kind of propelled that and made the call look maybe perhaps better than it was. So we've had, as Phil was kind enough to speak about a little bit, the US announcement of sanctions on Lukoil and Rosneft, and it seems like they're not really going to stop increasing Ukrainian drone attacks in Belarus, on Russian refinery infrastructure anyway. So, pricing. DEC NOV ice gasoil spreads up $15 per tonne, up to close to $25 per tonne currently. We've got the front spread at about $27 per tonne now, and it should be expiring any moment now. We've got ice gasoil cracks over $30 per barrel, and at their highest level since 2022, which was the kind of Ukrainian invasion year. We've got DEC heating oil spreads up by 2 cents per gallon over the same period, over the last fortnight. Diesel spreads up by over $1.50 per barrel as well. I mean, I just want to say there, Singapore products in general seem very strong. And it seems to be a big underlying factor in like middle distillate strength globally, really. This real strength that we see in East Asian distillates.
Okay. So what do the Arbs tell you about where we're heading from here then?
Yeah, so for some of those reasons we just spoke about, the gasoil East-West has widened by about $2 per tonne since the start of this week, so since Monday, and we're only at Wednesday now. That and the Jet East-West are at their widest ever levels for at least the last 9 years, particularly gasoil. This has been enough to point Middle Eastern jet Arbs and diesel Arbs finally west. Jet had been like that for maybe a week or so, but diesel's kind of just joined really today, if anything. Europe has also priced up enough to open US Gulf diesel Arbs into Europe, particularly in the prompt. The width of the US Gulf diesel diff has been really important there. I think maybe that's an anticipation of the fact that US crude runs should soon improve seasonally from here. And I think this will be like a bit of a watchword as we talk about the globe, is that refining margins are so strong that they're going to be incentivized to run really, really hard as they come out of maintenance now.
Yeah.
What do you think about US Gulf length on gasoline pricing at the moment, Jorge?
Yeah, it's something we'll talk later, but basically the exports are at the lowest point in the last 8 years. So we are feeling that already in the gasoline market. RBOB is very tight, not as tight as CBOB, but it's very strong, and we are starting to see fresh opportunities for the arbitrage from Europe into Path 1.
Well, thanks very much, Jorge. Also, however, the latest EIA stats still indicate, for some of those reasons that Jorge is probably going to talk about later, that US diesel yields have been decreasing for about the last 2 months. And as we just kind of spoke about, Middle Eastern jet Arbs are pointing west again as well. Though not quite open into Europe, that should kind of, well, I'll talk about more about in the trade calls later. But pointing west also for jet.
So that's all kind of pretty strong distillate market then in that case. So James, how do we translate this into trade calls for our listeners?
Yeah, the short term, I think, the very short term should be very, very bullish. So November pricing, we should see, it's probably happened already, we should see November ice gas will expire very strongly today. And there's kind of been like a bit of a play, like a number of shorts have kind of exited the market over the last few days, which has added to that volatility as well. However, with runs set to increase from here due to those previously mentioned stellar refining margins and also the end of global maintenance, I mean, there's a stronger and stronger argument to be made that maybe Jan spreads have been overbought.
Yeah.
Adding to that, December tends to be a low demand point, less economic activity in like EU and US, even in parts of Asia as well. We've seen, as we said, US Gulf Arbs open into Europe, jet Arbs pointing west again, diesel Arbs pointing west again as well. So I think that's a kind of medium call bearish view. Although it has to be said, in terms of like maybe like the medium to longer term view, there's got to be serious doubts about whether we're building enough diesel stocks before peak demand in like late Jan, Feb because of heating demand. And although kind of probably medium term bearish on jet as well, Europe, there's kind of also that kind of peak in jet demand that comes towards Feb as well, heating demand in Asia. That probably makes the longer term call on jet and diesel more bullish. I kind of feel like I didn't wrap that up very well. Short term bullish, November. December, I think there's an argument to be somewhat bearish. And in the long term, it's kind of the worries about building enough stocks before we get into the cold of winter.
Really good summary there. Okay, I think that was fairly clear. I think from what we're seeing here then, it's all eyes on inventory building, but certainly keeping an eye on how hard refiners run and back into that refinery capacity story of do we have enough? So going into kind of the latter part of the year. Right. Okay. So we had a little segue into Jorge midway through that. So keen to Jorge hear from you on the lighter ends of the barrel. So look, EBOB strength keeps on going. Do you think it can find a ceiling in the short term, or do we remain in this bullish market? Let's start there.
Yeah, just to add some numbers to the current strength. EBOB crack, well, all the gasoline cracks are at historical seasonal high at the moment, but not just in the prompt, but for the whole next year. That's the market that we have right now. It's really, really strong, and I find hard to be against that trend. But we have some various factors in the medium term, maybe Q1 next year, that we will see. But the main thing that we have seen in the EVOP market right now, EVOP is clearly outperforming RBOP and Singapore 92. We are seeing it on TAR and on Ace West. And the main reason we find it in West Africa. There are a lot of rumors, as Phil has said. Still, the market haven't priced any big change in the last couple of days. The uptrend keeps going. But what we have seen is an increased volume going from ARA into West Africa during October, but especially during November. The volume is at the highest level of the year. So that is one of the big reasons behind the strength in the EVOP complex. And there are a lot of uncertainties in the future because we are not sure if there will be some turnaround in December. And there is also this news about the new tax for gasoline imports in West Africa. If they have to keep importing it, it will be included in the price. So it will be even bullish for EVOP crack if they cannot meet the local supply in West Africa. Yeah, and overall, just to give a summary, I think the market remains very strong, keeping an eye on West Africa. And in the medium term, with these strong cracks in Europe, in US, in gasoline and in distillates, and some refineries coming again after the turnaround season, we can see some ceiling for this strength.
Okay, so a similar picture to James then, to a certain extent. You talked a little bit about RBOB. So US gasoline stocks are tightening, and it is definitely being translated into RBOB. So do you have anything else to add on this, kind of over and above what we discussed earlier?
Yeah, I think part of the strength in the RBOB right now is structural. So it's linked to the story about EVOP. But on the stock side, we have the lowest levels in PAD 3 in the last 8 years. We have stocks lower than the average in PAD 1. So after a very quiet period of the arbitrage from ARA into PAD 1, we are starting to see some opportunities. Maybe not for blenders, but for some refiners, there could be opportunities to send a Mark Carlos of RBOP into PAD 1.
Okay. And how does the arbitrage in the Atlantic Basin look now then in that case, now that we've gone through both of those markets? What's going on in ARA?
Yeah, so we've seen both indicators. And to talk about the competitiveness of each origin in the Atlantic Basin outlets, right now, the picture haven't changed much in the last weeks. Houston remain being the most competitive source of supply into almost all the destinations. But we find key outlets that still belongs to ARA. West Africa, for example, we have already seen. And the other one is Brazil, with this level of gas NAP in Europe and 29% of Naphtha into the gasoline blend, into the Brazilian gasoline blend. Yeah, it remains, ARA remains as the cheapest source of supply. So nothing has changed a lot. And looking from west to east, there are not many options to find new outlets in East Africa, for example.
I think that very wide gas NAP that we have in Europe is quite interesting as well. Something to look at. I think December gas NAP is now at $140 a ton, which is frankly ridiculous. It's wider than it was even during kind of 2022 when we had extreme cracks on gasoline and everything. So what it's doing is it's keeping ARA blenders or ARA kind of exports more competitive than they should be if you just looked at like a paper TAR or a paper East West, right? Paper TAR is very, very narrow. It's kind of almost record lows, but Europe is still very competitive into the West, into potentially into PAD 1 at times, but definitely into LATAM. And it's being driven by the fact that there's actually a lot of call for blending in ARA. Maybe we just don't have the finished kind of, you don't have the octane, essentially, in ARA at the moment.
Do we think that corrects itself, by the way, with refineries coming back from maintenance? Jorge, Phil, whichever one of you want to take that one.
Yeah, well, I agree 100% with Phil. Usually when we are looking at the arbitrage, we keep an eye on the paper a lot, also on TAR. And this time it has been different. So TAR is not finding a floor. It's really varies. And the Arb has improved a lot in the last couple of weeks. And that's basically because of the gas NAP in Europe. About the refineries coming back, we'll have to see the impact on the US Gulf Coast. If they are able to fill the inventories and go back to a most common level at this time of the year, we will keep seeing many different opportunities for US Gulf Coast exporters in the coming months.
Cool.
In terms of European octane kind of refineries coming back and solving that issue, I think the answer has to be yes, eventually, probably into December. So I think we can be bearish gas nap to a certain extent into December. And if you're bearish gas nap, you can be bullish TAA Arb again because they're linked. But if we look at, I'll talk about it when we talk about fuel oil, but FCC margins at the moment, reformer margin, every kind of margin at the moment is screaming max utilization. So we've lost some capacity over the last 12 months or so in Europe, but I'm not sure we've lost that much.
Okay. All right. Want to watch them when they come back. Jorge, while I still have you, can you give me a quick roundup of what's really interesting in the Naphtha market? So is the Naphtha market holding the tightness that we saw after the sanctions of the Russian entities? I think that's kind of when we were talking last on this podcast. Keen to hear your thoughts on this.
Yeah, I think the market haven't changed much in the last couple of weeks. At least if you look at the prompt time spreads, they have been trading with less volatility than since August until now. But there are some parts that are crucial. We still see East West very, very strong at record levels for now in 2026. And we've seen the market rolling in Asia from deliveries the first half of December to second half of December. And even with the very strong backwardation that we are seeing right now in the MOPJ market, the premiums have gone higher. So that is pushing the margins into the East even higher. So I think that has become now structural. So we have less product available from Russia and more risk after the sanction that we talked 3 weeks ago. And the Asian balance is tighter than what was expected for this last quarter of the year. So they will keep needing product from the West, either Europe coast or European market. So they are going to keep pushing in the paper with this West, in the physical with cash diffs to keep this arb open, and this is going to sustain the market. So I don't expect contango to come back to the European market, especially in the next weeks.
Okay, good call. Right, let's move on then to, sorry, before we do that, James, Jorge, I'm going to come back to you guys for just a really quick kind of one-liner of what you're looking at going into the next couple of weeks before that. But look, let's get into the quick fire round. This is the point where we try and be concise and fly through the rest of the barrel. So Phil, the challenge is yours for this week. We've been very light on crude so far, so why don't we kick it off with the crude markets and your recap here.
Sure. So crude, dated, and WTI this week. Dated we're going to talk about because there have been some fun and games again this week. Some unusually low WTI offers into the window, which have kind of had the slightly odd impact that they have kind of tanked dated structure at the prompt. And it's come along with some weakening of kind of physical premia as well on those North Sea barrels, which means that grades out of the North Sea, out of WAF, out of Med even are all looking really unusually competitive into the east. Azeri Light is landing cheaper than Murban. That happens 2% of the time over the last 12 months. So something kind of has to give there probably.
Yeah.
Because we have WTI landing over $2 or almost $2 over 40s for kind of late deck. So essentially kind of prompt physical arrivals for TI into Northwest Europe. So yeah, something not quite matching physical reality there. So some games being played in the data complex. And just on WTI, if we think about kind of what we've been seeing in the EIA data in the last few weeks, is that those US commercial inventory builds recently have not been particularly strong. So both outright stock levels and kind of refinery day supply, both below last year, which kind of doesn't really match with this whole, global glut story that everybody's been talking about for a long time. Part of that has been helped by the fact that, or caused by the fact that Gulf Coast exports have been very resilient for a long time and have been continuing to be resilient recently, despite WTI not having been as competitive as it was, let's say, in Q3 on an export basis into October. But those exports have remained really high.
Yeah.
Right now, WTI is very, very uncompetitive on a prompt basis, but that's December loaders. So it's going to take a while for us to see that kind of pull through into the export figures. And so essentially looking forwards now, we've got two potential directions for this. Either, okay, US stocks are low, WTI stocks are low, exports need to come off a little bit, in which case pricing is actually pretty fine right now. WTI is uncompetitive. Or you can get maybe we need to see a wider TI Brent again to re-incentivize those exports, because even as demand in the US ramps back up, maybe the US market is actually just fine with inventories being a little bit lower than they were last year. Incentives are there to get that oil out into the market. Refining margins are very strong. So
fair enough.
Two potential directions there.
Yep, not clear on which one we're going to move with first, but I did have a look at the crude signals dashboard yesterday and had to blink my eyes 3 times because it is red everywhere.
Very red.
For TI. So I did refresh the page thinking, oh goodness. Okay, maybe next week we'll do a bit of a deep dive then into crude a bit further. It'd be good to get kind of John maybe back on the podcast for this one as well. Okay, fuel oil, bottom of the barrel. Yep. How are we doing here?
Fuel oil, specifically on low sulfur, that and especially in the West, just really, really quite weak still. So unsurprisingly, I suppose, if you think about that, we've got secondary units offline, plenty of secondary units offline, and a decent amount of sweet supply out there. But if we look at how those kind of LSSR, so the low sulfur straight run resid FOBs are pricing, if we think about Skikta, barrels out of Gabon, for example, they're all pricing at levels that would suggest they are having to go into the bunker pool and not being pulled into refineries.
Okay.
Even though on paper FCC margins are fantastic, or secondary unit margins are fantastic, and everybody should be sweeping up as much of this low sulfur straight run as they can, the demand just isn't there, which points to that kind of refinery bottleneck piece that we were talking about.
Yep.
It's also not helped that if you think about kind of the biggest swing taker or marginal taker of resid, the US Gulf Coast, they don't want that low sulfur stuff. They're perfectly happy taking as much sulfur as you can give them. So in terms of this low sulfur straight run, especially whilst the Dangote RFCC is offline, if it does go offline, then probably the outlet for that is going to need to go east, and it's going to go far east. It's going to need to price appropriately to allow that to happen.
Okay, thank you for that. I think there's definitely a refinery feedstock story here that maybe Hua can help us out with in terms of just the price point between low sulfur resid optionality going into secondary units versus VGO, maybe, and that kind of blends straight back into your octane story potentially as well. So it could be kind of a more economic kind of feedstock story here. Okay,
dusting off the LP as we speak.
Yeah, brilliant. Thank you very much, Phil. Very happy. If you can get that running kind of within 30 seconds, that'll be awesome. But look, we can pick that up next week, and I'm sure we'll probably write about it as well. Okay, so quick round robin with all of you then. What's the 1 or 2 things that you're looking for? We'll keep it to 1 for this week. But James, what's the one thing that you're looking at kind of going into the next couple of weeks?
Yeah, so I guess the medium kind of bearish call is based upon returning supply after maintenance, increasing diesel yields, and a lull in demand. So I guess I'll be monitoring factors like high frequency stats that confirm that, hopefully.
Brilliant. Jorge, what are you looking at?
Yeah, I'd say West Africa, US stocks, and also refineries coming back after the turnaround season.
Okay, and Phil, where's your focus apart from running?
Jorge got me there, I was going to say, obviously we've got Antwerp, we've got Preem, and a couple of others coming back in Northwest Europe to keep an eye on for that ARA gasoline market. So are they enough to supply the octane, or is the fact that we've lost Grangemouth, we've lost Lindsay, we've lost a couple in Germany, is that going to just be enough to be structurally tied to our octane for a while, and we need this to continue?
Okay. All right. Thank you very much. Thanks all. That was really enjoyable. So that is a wrap for this week's Trade with Conviction, where the spreads are wide, the headlines are wilder sometimes, and yes, Dangote is yet again on our bingo card this week. We've only got a few episodes left till the end of the year, so let's see if his appearance finally gets us a full house. As we roll into the final stretch of the year, keep an eye on the Saudi term deals. We certainly will be. Sanction surprises and refinery comebacks that may or may not happen will continue continue to talk about that over the next couple of weeks. So look, if you agree, disagree, or have a chart that proves us wrong, send it our way. We love a good debate, preferably with data and caffeine involved. And for all of our Spartan Singapore listeners, don't forget our end of year social is happening tomorrow evening. So that's Thursday the 13th. And it's your chance to corner June and Hua with all of your burning trade ideas heading into the year end. And rumour has it that the rare Miles Mosley, Sparta's co-founder, will be in attendance too. Ask him anything you want on the Sparta story, provide him with a beer and he'll tell you the real story. So look, to register, please just check out our website. It is registration only and the team are more than happy to help there. So look, as always, thank you for listening. May your charts make sense and your coffee stay strong. And as always, trade with conviction.